All right, today we're going to talk about an invention that was literally born from a crisis and ended up completely reinventing how we invest. It's a three-letter ticker you've definitely heard of, SPY, SPY. But to really get why SPY was such a game changer, we have to rewind the clock. I mean, just imagine waking up and seeing a headline like this. That date, that was Black Monday, one of the most severe, gut-wrenching market crashes in modern history. And in all that chaos, regulators had this sudden, terrifying realization. They had a huge problem. The market was missing a critical tool, a really crucial piece of its financial plumbing. And it was right there, in the fallout of that historic crash, that the seed was planted for a brand new kind of security. So here's the big insight they had. The futures market? It had a single, super easy to trade contract for the S&P 500, but the actual stock market? Nope. If you wanted to trade the market, you had to somehow trade hundreds and hundreds of individual stocks. It was slow, it was clunky, and during a full-blown crisis, well, it was basically impossible. The SEC knew they needed a better way. And so, after years of hard work and development, a team over at State Street and the American Stock Exchange, they finally built the solution. You got to hear this story. On launch day back in 1993, a guy they called the plumber, Jim Ross, he was facing this monumental challenge. His team had to take a whole basket of 500 different stocks, instantly create a single brand new share out of it, and then, get this, complete a financial audit that normally took 45 days, and they had to do it all overnight. It was this insane feat of financial engineering, and nobody, absolutely nobody, was sure it would actually work. But it did. It worked. And just like that, SPY kicked off a completely new era, opening up the market for millions of people and starting this massive shift towards passive, index-based investing that we see everywhere today. And the results of that? Well, a simple $10,000 investment in SPY right at the beginning would have ballooned into this absolutely staggering amount. That's the power of just tracking the market in a simple, accessible way and letting it compound year after year. But here's the thing. SPY wasn't just a tool for growing your money. It proved to be an absolutely essential tool in a crisis. When the markets shut down after 9/11, traders used SPY to figure out what things were actually worth. And during the absolute panic of the COVID crash, it provided this deep, deep pool of liquidity right when we needed it most, trading a mind-boggling $100 billion in just one day. Of course, when you have that kind of success, you're going to get competition. And the market was definitely ready for the next evolution of this idea. Yup, in came BlackRock with IVV, and about a decade later, Vanguard launched VOO. Now, they both track the exact same S&P 500 index as SPY, but they were built differently, from the ground up, with a laser-like focus on one thing: driving down costs for you, the long-term buy-and-hold investor. And that really sets up the big question for anyone who wants to own the S&P 500 today. Which one of these three giants is the right tool for your job? Okay, so the single biggest difference between them is actually hidden deep in their legal structure. See, SPY uses this older design called a unit investment trust. A key weakness here is that it can't automatically reinvest the dividends it receives. So just imagine that cash just sitting there on the sidelines, not working for you until it gets paid out. That's what we call cash drag, and it can really hurt performance over time. IVV and VOO, on the other hand, use a much more modern structure that puts that cash back to work instantly, making them way more efficient. And you can see that focus on efficiency crystal clear when you look at the fees. SPY charges more than 3 times what its younger rivals do. Now, I know that difference looks tiny on paper, almost like nothing. But trust me, over decades of compounding, that tiny extra cost can create a serious drag on your final returns. So you're probably asking, why on earth would anyone still use SPY then? Well, the answer comes down to one word: liquidity. On any given day, over $30 billion worth of SPY shares change hands. That's more than 10 times its competitors, combined. For big institutions and traders who need to move huge amounts of money in the blink of an eye, SPY is still the only game in town. And SPY's total dominance for traders is really locked in by this massive moat it has in the options market. I mean, look at that. If you want to trade options on the S&P 500, you are, for all practical purposes, using SPY. This incredibly deep derivatives market creates this powerful feedback loop of liquidity that makes it totally indispensable for professional traders. So let's put it all together here. SPY is the undisputed king of liquidity and the options world, no question. But it comes with that higher fee and that structural cash drag. IVV and VOO are the modern, efficient, super low-cost alternatives, but they were really built for a different kind of person. So, with all that in mind, how do you actually make the right choice for your own portfolio?
It really all boils down to this one question. Are you a trader making moves day to day, or are you an investor trying to build wealth for the long haul?
And here's the simple breakdown. SPY is the heavy-duty precision tool for active traders, for hedge funds, for options experts. For them, its cost is way less important than its incredible liquidity. But for most of us, the long-term investors, the savers, the people focused on building and compounding wealth for decades, the lower fees and the more efficient structure of IVV and VOO make them the clear, logical, mathematical choice. Think about it. SPY was born from the rubble of the 1987 crash to solve a very specific problem. Its incredible success then paved the way for even better, more efficient products like IVV and VOO. It really makes you wonder, what market problem is out there right now just waiting to be solved? And what will that next great financial innovation even look like?